Short duration bonds, the safe play or the smart play? Our take on UTI's Market Insight Fixed Income June View. UTI's June Fixed Income View. Stay in the 1 to 5 year segment, avoid long duration bets, wait for clarity on inflation and oil. The destination looks reasonable. It's the route that may be worth a closer look. Here's the setup. The RBI has the repo at 5.25% and has been on hold with a neutral stance after more than 100 bps of cuts. It's told you the easing space is largely used up. When the cut cycle is done, long bonds lose their main reason to rally. There's no falling rate tailwind left to deliver capital gains. What's left at the long end is the risk. Heavy government borrowing supply plus oil and inflation hanging over it. So the long end is asking you to take real risk for very little extra yield over the short end. That appears to be a less attractive trade. That's why short duration wins right now, not as a defensive hideout, but because it's where you are paid fairly for the risk you take. You collect the carry, you stay liquid, and you are not exposed to a duration bet with limited upside catalyst. Where we part from UTI is the wait for clarity line. The clarity isn't a strategy, but the picture is clear, the trade is priced in. The position is the action. Sit at the front of the curve and take the carry now. The one scenario that flips this. If the oil stays soft after the ceasefire and inflation undershoots, the RBI could surprise with one more cut. And that's the only case that rewards stretching duration. On today's odds, it appears to be a low probability event. Don't forget to like, forward, and subscribe for regular updates.